Hello guys, I had to look at PayPal today from scratch. Knowing what I know about the latest quarter, the earnings call, the leadership reset, and the way investors reacted the moment management started explaining the plan, I would not begin with the valuation model. I would begin with a much harder question. Can this company still earn back trust? Because most people think this story is about whether PayPal is cheap, whether the quarter beat expectations, whether Venmo is finally waking up, or whether buybacks can save the stock. But that is not really the story anymore. The story is that PayPal can look cheap on paper, still generate real cash, still own valuable assets, and still become a painful investment if the people running it keep asking investors to believe in another reset. Today is Wednesday, May 6th in New York. Comment below what day and date you're watching from, because I want to see who is following this story as it unfolds. And quickly, before we get into it, if you value my work, support by subscribing and comment John A.G. Best. Simple, quick, and it tells me you're here for original analysis, not recycled noise. Now, PayPal's quarter was not some complete disaster. Based on recently published numbers, revenue grew in the mid-single digits, total payment volume moved higher at a low double-digit pace, transaction margin dollars were up slightly, and adjusted earnings were basically flat but still ahead of expectations. Active accounts barely moved, but transactions improved, and Venmo had one of the cleaner-looking parts of the report. Pay with Venmo grew strongly. Buy now, pay later remained healthy. Enterprise processing was still moving, so if you only looked at the spreadsheet, you could say, okay, not amazing but not broken. And that is exactly why the reaction was so important. The stock was not punished because every number collapsed. It was punished because the call made people less confident than they were before management opened its mouth. That is a very different problem. A bad quarter can be fixed by a better quarter. A credibility problem takes longer. Before the call, investors had a reason to breathe. The headline beat was there. The full-year guide was not blown up. Cash flow was still meaningful. The company was still buying back stock. Then management started talking about reorganizing the business, simplifying the company, using AI to remove duplication, cutting costs over the next few years, and reinvesting savings into growth. On paper, that sounds fine. Actually, it sounds responsible. But the market heard something else. It heard, we are still trying to figure out how to make this machine work. And that is where the patience snapped. Because this is not the first time PayPal investors have heard that the business needs to modernize. It is not the first time they have heard about legacy systems. It is not the first time they have heard that PayPal and Venmo need better coordination. It is not the first time management has said the company needs more focus, faster product delivery, and better execution. The frustrating part is not that the company has problems. Every large company has problems. The frustrating part is that the problems sound familiar, and when a new CEO comes in after already being around the boardroom, investors do not want a diagnosis that feels like it should have been obvious earlier. They want a plan that says, here is what we found, here is what we are cutting, here is what we are fixing, and here is when you will see it in the numbers. Instead, the message felt like another reset. And maybe that is unfair. Maybe the new leadership team is finally telling the truth more directly. Maybe they are lowering expectations now so the back half looks cleaner later. Maybe this is the medicine that should have been taken years ago. That is possible. But possible is not enough when trust has already been damaged. So let's separate the business from the stock. The business still has good pieces. PayPal's brand still matters at checkout. Venmo still matters socially. Braintree still has scale with merchants. The company still has data, risk tools, fraud systems, underwriting knowledge, and a network that touches consumers and businesses across many markets. This is not a zero. This is not a meme stock with a dream and no engine. But it is also not the easy value story people wanted, because payment volume is only one side of the equation. If volume rises, but take rates keep sliding, the business needs more transactions just to protect the same economics. If revenue grows, but operating expenses grow faster than investors expected, margin pressure remains. If Venmo improves, but branded checkout is only crawling, the strongest part of the consumer story is not yet enough to carry the entire company. That is the treadmill. And PayPal is still running on it. From recent market updates, competition in digital payments is not getting easier. Phone wallets are becoming more natural for consumers. Installment products are fighting for checkout space. Fintech apps want to become financial hubs. Merchant processors are bundling more tools. Big technology platforms want to own the customer layer. And merchants are simple. They want higher conversion, lower friction, better fraud control, and lower cost. So when PayPal talks about its right to win, I get nervous. Nobody has a right to win in payments. You win because the button converts. You win because consumers trust it. You win because merchants see better economics. You win because the product is faster, cleaner, safer, and more useful than the alternatives. That is execution, not a slide. Not a slogan, execution. And this is where the Germany example matters. Management talked about a product that worked, but also admitted they did not push hard enough. Now think about that. A major market. A product that shows promise. A company with thousands of employees, global data, marketing resources, engineering talent, and a brand people recognize. And the issue is, we did not push enough? That is not a small footnote. That is a cultural alarm bell. Because if a product fails because customers reject it, fine, learn from it. If it fails because the market is too early, fine, refine it. But if something is working and the company still does not execute hard enough, then the problem is inside the operating system of the company. That is what investors are selling. Now, to be fair, there is a bullish interpretation. The new CEO may be doing exactly what new CEOs often do. Take the pain early. Tell investors the house is messier than expected. Create new business units. Put one leader under each area. Start a cost program. Use AI not as a buzzword, but as a way to remove duplicated work, speed up product development, and cut customer support costs. Then reinvest part of those savings into the products that matter. That could work. But the market is saying, show me. And honestly, that is reasonable. The new structure makes sense conceptually. Checkout gets its own focus. Consumer financial services and Venmo get their own lane. Payment services and crypto sit together with Braintree and value-added tools. In theory, that creates accountability. Fewer handoffs, fewer committees, fewer excuses, more ownership. But reorganizations are easy to announce and hard to execute. Companies can move boxes around on a chart and still keep the same slow habits. They can rename divisions and still have the same meetings, same delays, same unclear priorities, same budget fights, same product bottlenecks. So I do not care what the org chart looks like. I care whether checkout improves, Venmo monetizes better, Braintree becomes more profitable, and margins stop leaking. If you're successful, share your success story in the comments so others can stay motivated. Because this is exactly the kind of investing lesson people learn the hard way. Cheap does not always mean safe. Let's talk about the cash, because this is where the bulls still have a real argument. PayPal is generating cash. It ended the quarter with a strong liquidity position. It bought back a large amount of stock. It has been returning billions to shareholders over the last year. Adjusted free cash flow was strong, and management still expects serious cash generation for the full year. That matters. Cash flow gives the company time. It gives management tools. It lets them buy back shares, fund restructuring, build product, hire talent where needed, and absorb mistakes. A weak company with no cash has no room. PayPal has room. But room is not the same thing as direction. A cheap valuation plus big buybacks can help shareholders if the business stabilizes. But if trust keeps falling, buybacks become a cushion, not a cure. They slow the bleeding. They do not heal the wound. The dividend is where I struggle. A small dividend can signal confidence, fine. But when a company says it needs to invest harder, modernize faster, push AI, rebuild products, reorganize teams, and compete against some of the most aggressive players in payments, I am not sure a dividend is the best message. If the opportunity is really that big, put every flexible dollar where it compounds best. That may be product, that may be buybacks, that may be debt management. But the capital allocation has to match the urgency of the turnaround. Now, the cost plan sounds big. Management is talking about at least $1.5 billion of gross run rate savings over a few years. That is not nothing. But spread across a company this large and then partially reinvested, it does not instantly transform the earnings power. It helps, yes. It can create flexibility, yes. But investors need to know how much actually drops into profitability and how much gets consumed by more spending. That is why the second quarter guide hurt. The next quarter is expected to be difficult. Earnings are expected to decline meaningfully. Transaction margin dollars are expected to be under pressure. Expense growth is still not disappearing. Management says comparisons are tough, and that may be true. But after so many resets, investors are not giving much credit for explanations. They want evidence. And this is the whole PayPal debate in one sentence. The numbers say undervalued, but the communication says wait. You can build a discounted cash flow model and easily argue that PayPal is worth more than where it trades. I understand that view. Lower the growth assumptions, use modest margins, add the cash flow, factor in buybacks. You can still get a value above today's price. But a model cannot rebuild trust. A spreadsheet cannot make branded checkout accelerate. It cannot make Europe improve. It cannot force Venmo to become a full financial super app. It cannot make AI savings real. It cannot make customers choose PayPal at the exact moment of checkout. It cannot make management sound credible after investors feel they have heard the same promise before. That is why value traps are so dangerous. They do not look obviously bad. They look reasonable. They give you enough cash flow to stay, enough upside to hope, enough assets to defend the thesis, enough cheapness to feel intelligent. And then every quarter becomes, just give it a little more time. And that is how you get stuck. There's also a bigger market context here. Payments used to feel like a clean toll road business. More online commerce, more digital wallets, more volume, more fees. Easy story. But the industry has matured. Checkout is becoming less visible. Consumers do not always think, I want this brand. They think, I want the purchase to finish in 2 seconds. That changes power. The winner is often the product that disappears into the habit, not the product with the loudest logo. And there is another quiet risk. Regulators are paying more attention to wallet economics, card relationships, and platform power. That does not mean something terrible is coming. But it does mean investors should not value PayPal like it operates in a quiet corner of finance. It operates in the middle of consumer payments, merchant economics, bank partnerships, and technology competition. That is a crowded intersection. This is why I do not want to be overly dramatic, but I also do not want to be sleepy. PayPal is not broken in the way a bad balance sheet company is broken. It is broken in the way a good asset can become trapped inside a slow system. And sometimes that is harder because the numbers keep giving you hope. And hope is expensive when time keeps passing without proof. So what would change the story? Simple. Branded checkout needs to show real acceleration, not tiny improvement. Venmo needs to prove it can grow and monetize without losing the consumer behavior that made it valuable. Braintree needs to grow profitably, not just process more volume at weaker economics. The cost program needs milestones. AI savings need proof. International weakness needs to stop being a recurring explanation. And management needs to stop sounding like it is discovering problems investors already knew existed. That is the checklist. Until then, PayPal may stay cheap. Not because the market cannot do math, but because the market does not trust the story enough to pay for the math. Now, does that mean the stock cannot work? No. Actually, the setup could work if the next few quarters show progress. When a stock is hated, expectations are low. Low expectations can be powerful if execution improves. If the second half gets cleaner, if the new checkout flow lifts conversion, if Venmo keeps compounding, if expenses become more disciplined, then the stock does not need perfection. It just needs proof. But if the next few quarters are more talk, more restructuring, more we are focused, and more margin pressure, then investors have to be honest. At some point, cheap is not an opportunity. It is a warning label, and that is why it might be time to sell and move on for some people. Not everyone, not automatically. But if your thesis was management has a clear plan and execution is already improving, then this quarter challenged that thesis. If your thesis was simply the stock is cheap, that is not a thesis. That is a number. Your job is to decide what evidence would make you stay and what evidence would make you leave. Write it down before emotion writes it for you. For me, PayPal still has the ingredients. It has not proven it can cook the meal. And in markets, ingredients are not enough. So be careful, be honest, and remember, this is for education and research only. I am not telling you to buy, sell, or hold PayPal or anything else. Your money, your risk, your decision. Use this as one piece of your work, then do your own research before touching a single share.